So, Tyler, in this summer, my portfolio was looking pretty good. My market had rebounded very, very strongly through like July or so, and things were looking like the bear market might be coming to an end. So, we're going to talk about that in a second. Before we do, please take a minute and click subscribe to my channel and check out the link you see on your screen for a message from my sponsor, The Motley Fool. You can get the top 10 stocks to buy right now, and it's the best way to support what Tyler and I are doing here. So, with the S&P down about 5% since the beginning of August, it's looking like a surprisingly good time to buy some of my favorite stocks at a discount. So, Tyler, why don't you kick us off with just what's one stock or sector or something that you're looking at right now?
All right, so I did a screen this morning and I was trying to really look at like some of the really cheap offerings out there in the market right now. And one thing I noticed, but I don't want to go there yet, is that banks look incredibly cheap right now. I don't know enough about banks to like make some really hard calls on anything that looks particularly cheap or like, the quality of their balance sheets. But, I went through a market screening and there are dozens of regional smaller banks right now that are trading for fractions of their book value. And so I think somebody who is a more tenured banking analyst, somebody might be on this video, might be able to kind of get into that. But it was something that I noticed and something that it interests me. But to actually go into a stock that I looked at right now is especially cheap. It's not in the S&P 500, but it still looks cheap in that way. We're going to go in the oil and gas services industry. I'm going to mention Precision Drilling. Precision Drilling is a company that owns and leases out drilling rigs onshore to oil and gas companies. It's a relatively smaller one. It's based in Canada. And what has been appealing to me lately is that the market for drilling rigs has been tightening quite a bit in the last several years. We've seen a lot of rig retirements. Labor right now is extremely tight in the oil patch, and so you have these tightening markets that is increasing the rate at which precision drilling and its competitors can get for its daily rigs. And for precision drilling specifically, it has been incredibly cheap because it had such a large debt overhang, especially during the crash in oil. But over the past couple of years, cash flow has been so robust. They basically cut their total debt down from like $1.3 billion down to about 700 right now, and they're looking to get down below 500 million. So it's a significant decline in debt. With that, we're going to start seeing a flow of cash likely towards investors in the forms of buybacks or whatever. And all of that comes right now at a price to tangible book of 0.9, so less than tangible book, and 5 times free cash flow. So I think if you're looking for something cheap, I think precision drilling is a great example of oil and gas services and probably one of the better ones.
So I am not the energy expert. I generally rely on you for energy picks and things like that. Last time I picked energy stocks, I got Transocean and an MLP that ended up going bankrupt. So I generally don't trust myself when it comes to energy stocks. But that definitely seems like a great pick, and that rationale makes sense. But on the banking side of things, I can comment. There are generally 2 groups of bank stocks I like right now. One are the big banks. Think especially Bank of America and Wells Fargo are 2 that I own in my portfolio. They're very cheap. They're trading kind of in tandem with the regional banks, which I generally stay away from right now because, all the turmoil earlier in this year. There's a lot of question marks when it comes to the new regulations that could be coming out. But the big banks are, they're too big to fail. We've kind of been told that. And they generally have very strong businesses. We saw that deposits really ticked up this year after a year or so of declines because people were fleeing for higher rates. But they're just strong institutions and trade, as Tyler mentioned, trading very cheaply. So those are 2. And then the other ones are kind of specialty players with high growth. Ally Bank is a good example of that. It specializes in auto lending, and it's not in the category of regional banks. It is a very consumer-focused bank. Virtually all of its deposits are FDIC insured, which was a big point of contention with the regional banks earlier this year. And it's trading at a very, very big discount to book value just because of fears, recession fears. It's an auto lender. People are scared that consumers won't be able to pay their bills, for lack of a better term. But we haven't really seen that reflected too much in default rates. Ally's default rates are kind of reverting back to pre-COVID norms, but nothing to be concerned about. So that's one pick I like in that area. But I wanted to also mention a company called Vici Properties. You probably heard me talk about this or write about this before, but generally I was writing about it as a REIT that was performing well, but was you were getting what you paid for. Now it's a REIT that's down by almost 20% from its recent highs and is more attractive than it was before. This is, think of it as the gaming REIT. Technically, it's a net lease REIT, just kind of like a Realty Income or something like that. But most of its properties are in the gaming industry. It's the biggest landowner on the Las Vegas Strip in history, and has some of the most iconic assets. Tyler, I'm sure if you've been on any sort of social media lately, you've seen the big MSG Sphere with all of its cool designs in Las Vegas.
The YouTube concert that they showed of that looked quite incredible.
Yes, so Vici owns that property. They receive rental income from that property. They also own the Venetian, which is essentially right in front of the Sphere. They own a bunch of the Las Vegas Strip casinos, the real estate behind them. They were a spinoff of Caesars Entertainment a while ago, and also acquired their kind of counterpart that spun off from MGM, and then bought the Venetian. So built a pretty impressive collection of assets. And not only that, while they were doing that acquisition spree, it actually added to per share FFO, funds from operations. So it's kind of rare to have a company kind of go that aggressive with acquisitions and have them actually be accretive to earnings. And if you it, that's generally a sign that management knows what they're doing when you can have acquisitions that really add to your earnings, not just make your company bigger, which we've talked about with some REITs that a lot of companies just like to get bigger and don't really grow their FFO over time. It's only been a public company since about 2015, but has increased its dividend every year since. Great financial quality that's given it some great investment opportunities, even in these tough times when most REITs have stopped growing. They have a lot of financial flexibility and great access to relatively cheap capital in the current environment. So they've been making financing investments. They financed the construction of properties for Great Wolf Resorts is one of their big partners with financing. If you've ever been to a Great Wolf Lodge, so that not only gives them kind of an alternative investment avenue in a rising rate environment, but also creates a future pipeline of portfolio growth, as they generally have the right of first refusal when it comes to sale of those properties eventually, so they can add those to their portfolio at some point. So that's one that I'm looking at. It has a 5.7% yield right now. Pretty much all of its customers, meaning the casino operators, sign 50-year leases. So great visibility into future cash flow. Most of their cash flow is linked to inflation, by the way, so they don't have to worry about that like most net lease REITs do. And that's just one that I think is really attractive right now. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.